Hi, this is Lara at Elliott Wave Gold with another trading room video update for you, done before market opens for the new trading week. I'm doing this Sunday the 9th of April Eastern Standard Time, just before markets open. I'm recording this video now, Eastern Standard Time, 6 PM Sunday evening. I'm going to look at copper, natural gas and British pound, US dollar pair. Let's take a look at copper first. It's range bound with resistance about 2.7 and support about 2.59. During this range-bound movement, it's this upward day which has strongest volume. That would indicate an upward breakout may be more likely than downward. That trick doesn't always work, it just works more often than it doesn't. But on balance, volume is giving us a conflicting signal here. It may be giving us a bearish signal with a break below this purple trend line. Now, I've spent some time today trying to play with this purple line and see if it could be drawn from here to here. That would be a stronger bearish signal. In other words, well, the break would be stronger, but the line would be weaker. This line is more horizontal. It's been tested more times, but it's not perfectly showing support and resistance. We had an overshoot here and an overshoot here, but then it's again found support here and support here. So this line does have some small technical significance. Preferably, to have confidence that price is breaking out downward, we really would need to see a strong downward day closing below support at 2.59, preferably with an increase in volume. The long lower wick of this last daily candlestick is quite bullish for copper. So for at least the very short term, I would expect a bit of a reaction, perhaps back up to resistance. And for stochastics to get back up close to overbought, but not necessarily moving into overbought territory. While price is moving sideways, RSI is neutral. ADX confirms that the market is not trending, it's consolidating. It's been consolidating for quite some time. Bollinger Bands contracting is typical of a consolidation, and ATR very low and steady, also very typical of a consolidation. So it's pretty clear copper is currently consolidating. Now this may offer a trend if we approach this with a good trading strategy, and an outline of a possible strategy is given for Elliott Wave Gold members in the membership area of the site. Let's have a look at the Elliott Wave count for copper. First, let's have a look at this really important trend line. This is on the monthly chart. This trend line goes back to 2011, drawn from prior highs across this high here to this high here, which was perfectly showing where price found resistance for February. That very strong line has now been tested 3 times at least. It's very long held. It's not too steep. The fact that it did provide resistance again here for February, and that February's month closes as a doji, puts the trend from up into neutral at this time. I would expect this trend line to continue to offer strong resistance. Let's have a look at the Elliott Wave count for copper at the daily chart level. I'm seeing a double zigzag structure complete up here. Importantly, this correction, which you can only see the end of here at the daily chart level, was a triangle, so you can't label this as a second wave correction. Second waves don't subdivide as triangles. So this may be an X wave, which means that this can't be a third wave, it's a Y wave, and it does fit neatly as a zigzag. If we have a double zigzag complete up here, what that means is it's very likely that this upward movement is over, because for it to continue further, it would have to unfold as a very rare triple zigzag. So we would have another X wave and then a Z wave. WXYXZ is actually really unusual, or rather very rare Elliott Wave structure. In my about 8 years of daily Elliott Wave analysis now, I've only ever seen about 2 or 3. And just a word of caution for you, for anyone watching this video who looks at other Elliott Wave work, WXYXZ is the most misused of all Elliott Wave structures. If you ever come across a wave count that has quite a lot of WXYXZ, don't give it any further attention. It's probably not following Elliott Wave rules, particularly if you see subdivisions of W, Y or Z themselves labelled WXYXZ. The maximum number of corrective structures within a multiple is 3. To label multiples within multiples increases the maximum beyond 3 and violates an Elliott Wave rule. Elliott Wave rules bar 1 are all black and white. If you're not going to follow the rules, then you really shouldn't be bothering to do it in the first place. Okay, so that's my word of caution about some of the Elliott Wave work out there online. If we have a double zigzag complete here, then we may be looking at the next wave down here, I'm going to label this as an A wave and expect it's most likely to unfold as an impulse at this time. It may have begun with a first wave impulse, an expanded flat second wave correction, another first wave impulse, another expanded flat correction. The subdivisions here fit very well, particularly the B wave. This is a three-wave structure. C moves beyond the end of A. There's no truncation. Expanded flats are very common structures. The only small concern I would have about this one is the overshoot of the blue base channel that contains minor waves 1 and 2. Usually lower degree second wave corrections find resistance or support at the extreme of a base channel drawn around a first and second wave 1 or more degrees higher. That usually works, not always, and this trend line here is overshot, but it's not properly breached. I define a breach as a full candlestick above and beyond and not touching the trend line. This is just an overshoot. Within minute wave 3, mini wet wave 2, if it continues further, and it certainly could go further as another flat correction or possibly a combination, it looks like it's most likely over there, but if it does continue, it can't move beyond the start of 1 above 2.717. So this wave count now expects a third wave at least 3 degrees to the downside for copper at this stage, which tells us that we should be expecting an increase in downward momentum, some big fat red candlesticks coming up, and this is my target for intermediate wave A to move at least beyond the start of primary wave Y at its eventual end. Let's have a look at the next market, and I'm going to give trading advice for natural gas in the membership section only for Elliott Wave Gold members. Natural gas has been in an upward trend. After it broke above this downward McGee trend line, it changed from bearish to bullish. It then found support at this line and it's moved up and away. The last post for Trading Room for natural gas was this daily candlestick here, the 31st of March, and I said that if natural gas came back down to touch the green McGee trend line for the new bull market, that would present an opportunity to enter the long trend. At this stage, natural gas is in an upward trend. 2 days later, that's what happened. Prices come down to very, very, very close, almost to touch this McGee trend line. That's a good, reasonably strong signal to enter long, according to the trading advice given in last Trading Room post. So if members have entered long here, we should now be moving stops up to protect profit. Positions should be profitable if you were able to enter close to the low of this session. We can use this McGee trend line now as a way to pull up trailing stops every day, calculate, or just eyeball it, where a stop should be set just a little bit below this line. Allow for small overshoots, but if this line is breached by a full daily candlestick below and not touching it, then I would be exiting a long position there. I'm going to watch on balance volume really carefully as well for natural gas. It's now got a small little consolidation. If it breaks below this yellow support line, then we may very well see a trend change and a subsequent break below the McGee trend line. For a bull market, draw a trend line using McGee's technique in that classic technical analysis of stock trends. That's one of my favourite technical analysis books. It gives some pretty strong, solid technical analysis advice. Draw the trend line from the first 2 swing lows within a bull market. For a bear market, you draw the trend line from the beginning of the bear market to the first swing high or major high within the bear market. So that's how I'm drawing these lines. RSI still allows further room for upward movement. ADX is telling us there is an upward trend. RSI tells us there's room for it to continue. ADX is not extreme, so that also tells us there's room for it to continue. When stochastics reaches overbought, that doesn't necessarily tell us the trend has to end. It happened here early on in the trend, and yet prices continued substantially higher. Stochastics can remain extreme for quite long periods of time during a strong trend, particularly for commodities. Only when it remains extreme for quite a long period of time and then exhibits multiple divergence with prices, it giving a strong warning that we may see a trend change, and that's not the case yet. So this is not yet giving us a warning despite being in overbought territory. That's an often misinterpreted oscillator. Bollinger Bands are still quite tightly contracted. Now that's a bit concerning for bulls, and so I'll be watching this trend line and this yellow line on balance volume really carefully to give us any warning of a potential breakdown in price. Next resistance about 3.55, so while price remains above this trend line, I'll be expecting overall this upward trend to continue. For natural gas, let's have a look at the weekly chart for natural gas. From this high to this low, if this is all the data I can get for natural gas, this is using FXCM data feed, it looks like a complete 5-wave structure. So if we've got a 5 down, we should be expecting a 3 up. I had expected cycle B was over here, but this downward movement is now completed as a 3-wave structure. We can't count this as the end of cycle B and a new wave down, because you can't count it 1, 2, 3, 4, 5, because 4 is in wave 1 price territory. So back when we got a new high above this low right here, that told us that natural gas is most likely now in another new upward trend. My target is for the most likely Fibonacci ratio between primary waves W and Y. So I'm expecting here that cycle wave B is a double zigzag subdividing 535X, and now we're expecting another 535 up for Y. Double zigzags are actually really common structures, and they usually have brief, shallow X waves. So at this stage, this possible double zigzag has a really typical look. Let's take a look at how it's unfolding at the daily chart level, where X is this slow down here. There's quite a lot of choppy overlapping within the early stages of this potential third wave, so I'm not going to put labels on it yet. Natural gas doesn't always have really good looking Elliott Wave structures at the daily chart level. I don't think it has sufficient volume, unlike gold, which is why I like to analyse that one every day. But so far, I expect that with this choppy overlapping we have in here, it's most likely that the middle portion of minor wave 3 may not have yet passed. I'm using the most likely Fibonacci ratio as a target for minor wave 3 to reach 1.618, the length of minor wave 1. That also happens to be at the nice round number pivot of 3.800. When it's done, minor 4, the following correction, can't move into wave 1 price territory below 3.088. This lower trend line on my Elliott Wave count is exactly the same as that green McGee trend line on my stock charts data technical analysis chart. Every time price touches this trend line, it's presenting us with an opportunity. While price remains above that trend line, assume the trend remains the same until proven otherwise. Assume the trend is still up, that's what classic analysis is telling us, until this line is breached. And finally, British pound looked like it was unfolding as a little pennant pattern, and so you would expect, given this is one of the more reliable continuation patterns, that we're going to have an upward breakout from this small pattern. What stock charts data don't show today is the candlestick for the 7th of April, which was a strong red daily candlestick closing well below the lower edge of this little pennant pattern, and it came with an increase in volume, so price has broken downwards, not upwards, from this small pattern. While price has essentially been moving sideways for about a couple of weeks to trace out that pattern, ADX has turned from up to declining now, telling us that the market has finished the upward trend and is now consolidating. It's got a way to go before the positive and negative DX lines can cross, telling us we have a potential trend change. This is a lagging indicator. It's based on a 14-day average. While price moved sideways within that pattern, ATR also declined, agreeing with ADX that the market was consolidating. RSI neutral, stochastics neutral, and Bollinger Bands also contracting, telling us that the market was consolidating. So a really simple approach to a consolidating market is to draw your trend lines showing resistance and support and wait for a breakout. In this case, you would have expected it was most likely to be upward because it's a pennant pattern, but it could also be downward. Wait for the breakout for a day to close comfortably above resistance or below support, preferably on a day with increased volume, especially important for an upward breakout, for volume to support the upward movement in price. Let's see what happened. We actually have a downward breakout. Now, stock charts data do not provide volume data for currencies, for Forex, so I'm going to use my FXCM data feed to do some volume analysis. During this huge, big sideways consolidation, it was an upward day. which had the strongest volume. It's this day right here. Now that would normally tell us that it's more likely we're going to see an upward breakout than downward from this consolidation. We also have a strong downward day, so the signal is reasonably clear, but it's not as clear as I would like it. Let's have a look at on balance volume. For the very short term anyway, and I prefer to use on balance volume for these small consolidations and wait for a breakout, we've got a downward breakout from price and a downward breakout from on balance volume. So at least for the very short term for the British pound, it looks like we've got a downward breakout below support confirmed or supported by on balance volume. So for the short term, I'd be expecting a continuation now of some downward movement from the British pound, and it had support from volume here. Let's have a look at the Elliott Wave count. Going back to the monthly chart first, going back to the beginning of 2008, I'm seeing an impulse or potentially a zigzag unfolding lower. So we've got a 5, 3, we need the next 5 down to complete. It's either a third wave or a C wave. So a third wave of an unfolding impulse or a C wave of a zigzag, which will be over with the next fifth wave down. So within the cycle degree third or C wave, we've got 1, 2, an impulse for 3, which importantly exhibits no Fibonacci ratio to 1. It's longer than 1, but it's not quite as long as 1.618, the length of 1, I think. A fourth wave triangle may have just ended. If it continues sideways and morphs into a combination, sometimes triangles can do, it can't move into wave 1 price territory above 1.45661, but that invalidation point is far too far away to be of any use to us as traders, so I've got a closer invalidation point for you at the daily chart level. I'm going to assume the most common ratio for the final fifth wave to reach equality in length with the first wave, so here's my target for the next wave down. Let's take a look at this triangle at the daily chart level, where the third wave at primary degree may have ended here with a strong selling climax. This is where the triangle begins. 4 of the 5 subwaves of a triangle must subdivide as zigzags or multiple zigzags, but only one of them can be a more complicated multiple. Wave A subdivides nicely as a double zigzag, so here's our more complicated multiple. B fits perfectly as a zigzag, as does C, D and E. E falls slightly short of the AC trend line. That's the most common point for E waves of triangles to end. With all of that said, this is a regular contracting triangle. It has a perfect fit, a perfect look. It looks absolutely typical. That meets all Elliott Wave rules, all the subdivisions fit. So I've got reasonable confidence that that's what happened, and it's now very likely to be over because E has fallen a little bit short of that AC trend line, and it's a complete zigzag. The triangle is supported by MACD essentially hovering about 0 at the daily chart level as it unfolded. I would have a little bit more confidence in this though if it was even closer to the 0 line. It's fluctuating about 0. I like to see, particularly at the end of triangles, MACD essentially sitting flat on the 0 line. It didn't do that, but it's pretty close, and it doesn't always do that. So let's assume it's reasonably likely we've got a triangle over here. Now if that's the case, given the larger picture for the British pound, the Elliott Wave count expects a fifth wave down at primary degree to reach equality in length with the first wave. There are only 2 structural possibilities for a fifth wave. It can only be an ending diagonal or an impulse. It's much more likely to be an impulse. We may have the first wave incomplete. A first wave at intermediate degree should last weeks, if not months. So far, we may have 1, 2, 1, 2, and now moving into a third wave at 2 degrees. I've drawn a blue base channel around the first and second wave. Second wave corrections at lower degrees should find good resistance at the upper edge of this base channel. If minute 2 here does continue further, and it could be continuing sideways as a flat, an expanded flat, or a combination, then it can't move into wave 1 price territory above this price point, but it shouldn't get too close. It should find resistance at the upper edge of this base channel. Now we have to allow for overshoots, but if we see a full daily candlestick above this trend line and not touching it, I would discard this wave count. I would then expect that primary wave 4 may not be a triangle, and this correction could be morphing into a combination, and I would adjust my entire analysis of this whole point if that trend line is breached. Now, I've given some trading advice for the British pound under the Elliott Wave section, just for Elliott Wave Gold members only. So if you want to access that analysis, you'll have to join the membership of Elliott Wave Gold, and we've got a 1-week trial for $1. That's all for me with your trading room advice this week, and I hope that all of my members had a fabulous weekend.